Hey everyone, welcome back to Corporate Decoder. Today we're diving into a real estate company's financial report. It's a bit like exploring a haunted house. You never know what skeletons, or in this case debts, you might find. This company, Abbey Commercial Real Estate Private Debt Fund, focuses on lending money secured by commercial properties. We're going to see how they did in 2024, what risks they're facing, and if this investment looks like a gold mine or a money pit. First off, this is a Form 10K, which is basically an annual report card for companies. It tells you everything you need to know, and sometimes more, about how a company performed over the past year. It's required by the SEC, the government agency that watches over companies to protect investors. This report covers the year that ended December 31, 2024, so it's a look back at the entire year. The company is called AB Commercial Real Estate Private Debt Fund LLC. They invest in loans secured by commercial real estate, things like office buildings, hotels, and apartments. Think of them as a bank, but for bigger real estate projects, giving out mortgages, so to speak. Their main goal is to make good money for their investors, called members here, by carefully choosing which real estate loans to invest in. They want returns that are worth the risk they take. They focus primarily on mortgages. This filing mentions that they've elected to be taxed as a real estate investment trust, or REIT. A REIT basically avoids paying corporate income tax as long as they distribute most of their taxable income to their investors. It means more money can go to you instead of the government if they qualify. Let's dive into the financial details, and I will explain what I find interesting and important. They declared 100% dividends in both 2024 and 2023. This means all the income they wanted to distribute was in the form of dividends. Now let's check the good stuff, how much each unit is worth. In December 2023, each unit was worth 9.64 cents. But by the end of 2024, it dropped a little to 9.48. It's not a big drop, but still indicates they did not have a good year. Is it bad news? Is this a big deal? Not really. Let's explore. Now let's jump to their consolidated statements of income. This is where we see how much money they made and spent. First, let's scroll to assets. Here is the interesting part. Their main source of income, net interest income, jumped from $3 million to $37 in price their expenses to get that money. Let's take a look. Operating expenses rose from $5.7 million to $10 million. The big reason, management and incentive fees. Management gets paid no matter what, so the more assets they manage, the more they make. Incentive fees means the managers get a cut of the profits, and the report shows that they performed better than last year, so they get higher bonuses, and therefore operating expenses are higher. In investing, it's important to not just see the revenue, but also the cost of revenue. The company here spends significantly more, so their profit is not as great as it looks at first glance. The company had outstanding investments in 13 floating rate loans with a loan balance of $871.5 million. Most of these loans are first lien and are spread out across different property types, with mixed use being the biggest at 29% and then multifamily at 24%. This is good. It shows they're not putting all their eggs in one basket. To make those loans, the company borrows money. It's like taking out a mortgage to buy a house. They'd borrow money to invest. These are called debt obligations and include State Street Credit Facility, similar to a credit card, repurchase agreement, and HSBC loan days of December 31, 2024. The amounts for these were 38.24. The amounts for these were 38.2046 100 as of December 31, 2024. The amounts for these were 38.2046 141 2024. The amounts for these were 38.2046 141 to 2024. The amounts for these were 38.2046 141, which is 424. The amounts for these were 38.2046 141 2024. The amounts for these were 38.246 141, which is 424. The outspats were about 50% leverage. Repurchase agreements are especially interesting. They increased their loan amount from 186M to 246M year over year. Now, this is where it gets interesting because when you are highly leveraged using debt, the returns may be big, but the losses are also big. Let's move on to the risks part. Reading through the risk report, it shows that the success of their investments depends a lot on the economy. Things like rising interest rates, recessions, and changes in laws can hurt their profits. They mention the uncertainty around the current Russia-Ukraine war and what it means for them. The company relies heavily on the investment manager to make good calls and manage the investments well. They don't mention it, but losing the investment manager is a risk. The company also needs to avoid being classified as an investment company. If they did, they'd have to follow a whole bunch of rules and regulations which could limit what they can do. To avoid this, a large percentage of their investments needs to be in real estate related loans. They also highlight the risk of cyber attacks. Because the world is in a sad state where people will try to hack you, it is always a major risk. They also outline common real estate risks. They plan to mitigate these risks and protect investors' capital, but there are no guarantees. Now to the 10K report overall. The fees paid to their auditing company have also increased, nothing too unusual here. The company has many subsidiaries. It is standard for large companies, but it increases the organizational complexity of the firm. So what do I think Abbey Commercial Real Estate Private Debt Fund is playing in a risky but potentially rewarding game? Lending money to real estate projects. They made more revenue this year, but also spent a lot more to get it. The company is in a leveraged position at about 50% debt ratio. This might boost returns in good times, but it will magnify losses during bad times. There are a lot of external risks that are outside of the company's control, but in general, what matters is if the investments they make will go up or down. If the company can find good deals, this is a great investment, but this report does not show any obvious advantages the company would have in this arena. If you are risk averse, this is probably not a great investment for you. Thanks for watching. If you found this helpful, please hit the like button and leave a comment. Don't forget to subscribe for more deep dives into the world of corporate finances.